Gold, the shimmering metal that has captivated civilizations for millennia, has always been a roller coaster of price fluctuations. On May 12, 2025, this roller coaster took a steep plunge, leaving investors bewildered and analysts scrambling for explanations. The precious metal, often seen as a safe haven during times of uncertainty, experienced a dramatic 3% drop, plummeting to $3,225 to $3,237 per ounce. This sudden decline, a significant departure from its recent peak above $3,500, has sparked widespread discussion and debate among market watchers. This wasn't just a blip on the radar, it was a $100 drop in a single day. Understanding the factors behind this sudden dip requires a closer look at the events that unfolded on that fateful day. As we delve deeper into the events of May 12, 2025, we'll unravel the key factors that contributed to gold's wild ride and explore what this means for investors and the global economy. At the heart of gold's May 12th plunge lies a surprising development in the US-China trade war, a 90-day truce. This unexpected agreement between the world's two largest economies sent ripples through global markets, directly impacting the price of gold. The trade war, marked by tit-for-tat tariffs, had been a source of uncertainty for months, driving investors towards the perceived safety of gold. The US agreed to lower tariffs on $200 billion worth of Chinese goods from a hefty 145% to a more manageable 30%. In return, China slashed tariffs on US imports from 125% to 10%, offering a much-needed reprieve for businesses and consumers on both sides. This easing of trade tensions had a significant impact on investor sentiment, prompting a shift away from safe haven assets like gold and towards riskier, potentially more profitable assets like stocks. This optimism led investors to pull their money out of gold and pour it into the stock market, perceived as a bet on future economic growth. Adding fuel to the fire of gold's decline was the surge of the US dollar. The greenback, buoyed by the positive sentiment surrounding the US-China trade truce, climbed to a one-month high against a basket of major currencies. This strengthening of the dollar further dampened the demand for gold. The relationship between the dollar and gold is like a seesaw. When the dollar rises, gold typically falls and vice versa. As the dollar gains strength, gold becomes more expensive for buyers using other currencies, making it less attractive to international investors. The stronger dollar, coupled with the risk-on sentiment triggered by the trade truce, created a double whammy for gold, pushing its price further down. The greenback's rise, reflecting renewed confidence in the US economy, further reduced the appeal of gold as a safe haven. This dynamic played out in full force on May 12th. Section 4. Geopolitical stability dampens gold's appeal. Adding to the confluence of factors weighing on gold was the announcement of a ceasefire between India and Pakistan. These neighboring nuclear-armed nations, locked in a long-standing conflict, agreed to a temporary halt in hostilities, bringing a sense of relief to the region and beyond. This unexpected turn of events further contributed to the shift away from safe haven assets like gold. The ceasefire, coming on the heels of the trade truce, signaled a broader easing of global tensions, bolstering investor confidence and reducing the perceived need for safe haven assets. This stabilization further dampened the allure of gold as investors felt more comfortable venturing into riskier assets in pursuit of higher returns. Section 5. Expert opinions and market reactions. The sharp drop in gold prices on May 12th sent shockwaves through the market, prompting swift reactions from analysts and investors alike. Adrian Ash, head of research at Bullion Vault, noted the metal's susceptibility to sharp reversals, particularly in response to unexpected news like the trade truce. Gold's reaction to the news highlights its sensitivity to shifts in market sentiment, Ash commented. Jim Wyckoff, a senior analyst at Kitco Metals, echoed this sentiment, pointing out that the technical picture for gold had deteriorated significantly. The sharp decline has pushed gold futures below key support levels, suggesting that the bears are now in control, Wyckoff explained. Despite the bearish short-term outlook, some analysts remain optimistic about gold's long-term prospects. Goldman Sachs maintains its bullish stance on the precious metal, forecasting a price of $3,700 by the end of 2025 and a potential surge to $4,000 by mid-2026. Section 6. Navigating the Golden Seas. Investment Strategies and Future Outlook. The recent volatility in the gold market serves as a stark reminder of the importance of diversification and a long-term perspective in investment strategies. While gold can play a valuable role in a diversified portfolio, it's crucial to avoid overexposure and to maintain a balanced approach. For investors considering adding gold to their portfolio, it's essential to carefully assess their risk tolerance and investment goals. Gold should be viewed as a long-term investment, a hedge against inflation and economic uncertainty, rather than a get-rich-quick scheme. Looking ahead, the future of gold prices hinges on a multitude of factors, including global economic growth, inflation trends, interest rates, and geopolitical developments. The US-China trade truce, while positive in the short term, remains fragile, and any escalation in trade tensions could reignite safe haven demand for gold. By staying informed, diversifying investments, and maintaining a long-term perspective, investors can navigate the golden seas with greater confidence.